The world of mortgages and home buying can overwhelm first-time buyers, and honestly, it's easy to understand why. This is something you might do just a handful of times in your life. You've got all of these new words and phrases and acronyms, and it can all get confusing in a hurry. That's why it's important to start with some home buying basics. Taking time to learn about this process and this whole new world, it'll ultimately make you a stronger home buyer and put you in the best position possible to get a great deal. So we're going to talk about a few different things in this video. Let's first start by talking about the difference between mortgage and loan. People tend to use these words interchangeably, but they're actually two different things. So the lender is going to make a loan that allows you to purchase a property. You're going to sign a promissory note that pledges to repay that money over time with interest, of course, and it's typically over 15 or 30 years. Now, a mortgage, this is something different. This is a legal document that you sign and goes to the lender. The mortgage provides security for the loan, which basically means the lender can take back that home if you stop making payments on the loan. Now, in some states, that legal instrument, the mortgage, you might hear it called a deed of trust in some places. It's really the same thing. Now, once you pay off this loan, the lender releases the mortgage and they can no longer have a claim on that property. You own it outright. Now, next, let's talk about fixed and adjustable rate mortgages. Now, homebuyers can choose between a fixed interest rate for the life of their loan or an adjustable rate mortgage, or an ARM. Now, the fixed rate mortgage locks that rate in over 15 or 30 years. You don't need to worry about your rate changing over time. That also means that the principal and interest portions of your mortgage are set throughout. Now, an adjustable rate mortgage, this has a variable rate. That means it can go up or down at different times throughout the life of the loan. Now, there's a host of different types of ARMs out there, each of which have their own potential risk and reward. Next, let's talk about mortgage terms. Now, the mortgage term determines how long you're scheduled to make payments before the loan is paid. The length of that term also affects how much you pay month in, month out toward the principal balance and interest. Now, most mortgage terms are 15 years or 30 years, but there are a lot of other options out there. Now, loans with 15-year terms typically come with lower interest rates than 30-year mortgages. Now, the chief benefit there is that with a shorter loan term, you pay less in interest over the life of the loan. The downside with that being that your monthly payment is more because you're shrinking that timeline. So it helps to look with numbers and have an example. So let's look at a $200,000 fixed rate loan. Now, with a 30-year mortgage term and a 5% interest rate, the monthly principal and interest payment is about $1,075. Over 30 years, you're paying about $186,000 in interest. Now, if you shrink that mortgage term to 15 years, you're usually going to start with a lower interest rate, so we'll say it's 4.5% for this example. Your monthly mortgage payment jumps to about $1,500, but over the life of your mortgage, over those 15 years, you're paying only about $75,000 in interest. That's a significant savings because of that shorter loan term, but your monthly payment, the principal and interest portions, those are jumping by nearly 50%. So when you're thinking about what kind of mortgage term do I get, think about things like how long you plan to live in the home, how much of a housing payment you can afford, and other important factors. So also, another thing to keep in mind is a lot of home loans, including VA loans, don't have any kind of prepayment penalties. That means that you can pay additional money every month or every year towards your principal balance, and that can help you build equity faster and pay off your loans sooner, even if you're sticking with that traditional 30-year mortgage. Now, last, let's take a look at the major types of home loans out there, and we'll do it in the context of these key 4 considerations. Some of those loan types will be a better fit for you than others. Now, you can typically divide home loans into 2 basic categories. There are government-backed loans like VA, FHA, and USDA, and I'll just go ahead and write those up here. And then there are conventional loans. Those are loans that aren't guaranteed or insured by the federal government. All of these types of loans come with their own benefits and drawbacks, and they can impact people in different ways. So we're going to look at these 4 considerations and talk about how they stack up with those types of loans. Now, the first is credit and credit scores. Now, credit score minimums are going to vary depending on the lender, the loan type, and other factors. You're usually going to see lenders looking for a 600 or a 620 FICO score for any government-backed loan, so USDA, VA, FHA. For conventional lending, it's usually a little bit higher of a FICO score, often around a 660. But with conventional loans, you will often need really good credit, more like a 740 FICO, to have a shot at the best rates and terms. Conventional loans also tend to be less flexible and forgiving when it comes to things like previous bankruptcies, foreclosures, and other forms of derogatory credit. Down payments is another important consideration, and these also vary by loan type and by lender. So with FHA financing, you're typically looking at a 3.5% minimum down payment. For conventional loans, it's often 5%. You may be able to find lenders out there willing to go as low as 3%. With USDA and VA loans, qualified buyers can purchase with no down payment, which needless to say is a huge benefit. So upfront funding fees is another big one. Government-backed loans carry upfront insurance premiums or funding fees that usually get added to your loan balance. You end up borrowing more money with these types of mortgages in some cases. And the upfront mortgage insurance premium for FHA borrowers, right now it's 1.75% of the loan amount. For USDA borrowers, it's 2.75%. And most VA buyers out there pay a funding fee of 2.15% of the loan, although you don't have to pay this if you're currently receiving compensation for a service-connected disability. Conventional loans do not have any sort of upfront funding fee. Mortgage insurance is the last key consideration that we'll talk about. Both FHA and USDA loans, along with that upfront mortgage insurance cost, they also have annual insurance premiums that can add $80 to $100 or more to your payment every month. Conventional borrowers usually need to pay for PMI, private mortgage insurance, unless they can put down 20% of the purchase price. 20% of $200,000 would be a $40,000 down payment. Now, what you pay in PMI can vary depending on your credit, your loan-to-value ratio, and other factors. VA loans, those don't have any kind of mortgage insurance, and for so many veterans and service members out there, the VA loan program is the most powerful mortgage product on the market. VA loans come with no down payment, no mortgage insurance, and tend to have more flexible and forgiving requirements, along with some other big-time benefits. But a home loan is not a one-size-fits-all product, right? Everyone's home buying journey is different. So when you're talking with lenders, the focus should be on finding the right loan for you, the one that makes the most sense given your credit, your finances, and your home buying goals.